Okay, folks, good morning and welcome to a special edition of Swing Trading Today. I normally don't do these on Mondays, but we have a special situation setting up here, which has already set up, and we really identified the risk here last night on Sunday Night Futures Live, where we reviewed the opening price action of the major averages, and pretty much all of them gapped up, only to reverse pretty rapidly. And we have woken up this morning with the S&P 500 down over 2%, and that's well off the lows of the session. Now, I will point out that on this 4-hour chart, we are trading down below this lower band of the Bollinger Bands. This is a 3 standard deviation Bollinger Band. In all probability, we're going to get a rally back. This bar opened up at 5 a.m. So we have just shy of an hour and a half worth of trade into this bar. A lot can happen between now and 9 a.m. Hey, Sam, good morning. But there is a tug of war going on. If you take a look at a 15-minute chart, they did flash an outside reversal bar. They're struggling to get it to proceed higher. We'll just set up a quick alert here. Hello, Kay. Good morning to you. All right. So we'll be looking for a continuation push off of this low. I'm not going to be the least bit surprised to see it happen. Now, moving on to let's take a look at we'll continue on with equities. Then I want to go to bonds and the U.S. dollar. The Russell 2000. Now, why am I not upset this morning with the Russell 2000 down nearly 3.5%? We're hedged. We have a hedge on. So we're good here. You could see that last night when we first opened up, we flashed an outside reversal bar, signaling a potential sell-off, and we have it. But very similar as to what we're seeing on the S&P 500, we are oversold relative to the 3rd standard deviation Bollinger Band. The 15-minute chart probably looks similar. It does. Here's that reversal bar. We've been rejected in our efforts to try to rally through resistance to have a continuation sell-off. Now, what I will say is this, is that it'll be very, very rough for bulls if we continue to push lower and we fail to get a counter trend move up higher. That would be technically significant because the probability of us moving higher to alleviate this quote unquote oversold condition is pretty good. But in a weak market, weak stocks tend to get weaker, and that will not bode well should we break down to new lower lows prior to rallying, thus alleviating this oversold condition. Now, we could trade sideways. That's certainly a possibility, and alleviate that oversold condition without rallying. But that is not good for bulls. Taking a look at the NASDAQ 100, faring less worse than the rest of the market. Unlike the S&P 500 and the Russell 2000, we have yet to break support. They tried to, but buyers moved in. Now, what's the cause of this sell-off? Well, I mentioned it last night, and I've been saying it, that while we have a deal at hand, it's not enough. I don't even agree that the Federal Reserve or the Treasury should be providing all this corporate welfare. But be that as it may, they put a $2 trillion earmark into the minds, a seed into the minds of traders prior to the election. And to pass a $900 billion, I don't think they passed it yet, there's rumor they'll pass it, to offer up a $900 billion stimulus is a disappointment. Add to that, look at the rally that we've had since the election. Look at this W formation. This is a weekly chart. Look at the rally. They've pulled this all forward. The expectations of a stimulus package are already built in. That being said, am I going to be a net shorter of this market today, tomorrow, before the new year? I highly doubt it. Why? It's because seasonality. We're going to go to that in a moment. I'm going to use TrendSpider, and I'm going to illustrate for you what kind of seasonality we're looking at in terms of this time of year. It's not healthy historically to become net short prior to the new year. After the new year, different story. But right now, you have computers that are going to manage this market. They could drift it up higher on very, very light volume. You may get some tax loss selling in those cyclical names that are weak, such as energy, maybe some of the banks. Let's take a look at the U.S. dollar. We'll go back to a 4-hour chart. You can see how the dollar is ripping because the stimulus deal just wasn't what was expected. They wanted, traders had a $1.8 to $2 trillion mark in their heads. They're way shy of that number. So this is a relief rally on the U.S. dollar. Believe me, this dollar rally is not going to last. Yes, this is a rip your face off short covering rally on the dollar. It is not going to last. We are going to roll over. Sam, on the news, we got full of news about Corona. December, UK should leave the Eurozone. That's the major issue for the euro so far for the dollar. Yeah, the UK has got a really extraordinary set of circumstances going on over there. And I don't, from my perspective, I'm not drawing conclusions because I'm no expert. From my perspective, it doesn't look as though the Brits have been all that good at managing their economy or managing this lockdown. Here's the British pound. It's getting annihilated. The euro, not as bad, but certainly taking a breather. Let's take a look at the Japanese yen. Yen taking a breather as well. In fact, this is a 4-hour chart. We have a lower high and now a lower low. So it looks like this week, maybe the week of the dollar. Now, that being said, overnight, when it came down to gold ripped. And when I went to bed last night, we were trading above 1,900 the ounce. But we've given up all of those gains, and we've retraced and are now trading lower than Friday's lows. So a big reversal bar here on gold. Daily chart. At current, we have an outside reversal bar relative to Friday. So this is pretty bearish. What this could be is a retest of the breakout point. We had one back here. Like we broke out on the 16th, did a retest on the 17th, rallied, faded off the highs. Actually, no, Friday was a down day. Rallied last night, faded off the highs, retest today. Does it hold? I think it does. I think it does, despite the U.S. dollar. And the reason why is that yes, they normally trade inversely of one another, But when you have geopolitical risk, they can trade in tandem as they are perceived to be safe haven plays. So if you have Great Britain locking down with a third strain, Lord knows where that'll reemerge or emerge elsewhere, whether it be Europe, the United States, wherever. That can cause more panic in the markets, forcing money into money market funds, gold, silver, etc. Speaking of silver, let's see how we're faring. Where's my silver? Should have had this ready. Here we go. Yeah, very similar price action on silver, where we had broken out on the 17th, retest on the 18th, a follow-through breakout overnight, only to fail and get rejected. We retested not one support level, but two. And they appear to be holding. So I'm gonna wait out the storm here. We do have exposure to silver. I think that ultimately bulls will win out here, especially as we move into a seasonally favorable period of time into January. So we'll be sending out alerts when we go adding to our gold mining, silver trades. And in fact, let's check out the GDXJ. That's been volatile all morning. And we are up this morning versus Friday's close, which is good to see. Check out copper. Copper coming in. In fact, copper broke down below support. So this is typical US dollar strength, copper weakness. Ten-year bonds, money rotating into bonds this morning, forcing yields lower. We'll see if this lasts. I think that ultimately we're going to see a correction further to lower lows on bonds, yields higher, and US dollar lower. It may get a pass this week, but after that, I think that the bears are going to resume ownership of the trend of each. Hey, Tommy, how you doing, buddy? Yeah, a lot of volatility out here this morning. All right. I'm going to keep this brief this morning, folks. We'll go over BABA. Oh, I want to talk about seasonality first. You know, when you go back, I want to bring up this chart here. This is the spiders. And you can go back 21 years. And you can see that December, we're up 67% of the time. That drops off dramatically in January. So this is why I'm reluctant to go aggressively shorting this market. We have a hedge on. And you can see over the past 15 years, December up 76% of the times. So no great rush here to getting short. Now, as for the trip Qs, different story. Seasonality in January, typically favorable for the Qs. Not too bad in December as well. So, again, no great rush to go getting aggressively short. This is going to be light volume trade this week. They can move this market on very few shares. BABA, let's bring that up. And this segment's brought to you by TrendSpider, our partner. And if you want to automate your grunt work of doing technical analysis, folks, TrendSpider is for you. Improve your accuracy, time your trades with precision, and find winning trade setups. They have the market scanner that is absolutely outstanding. They really did an upgrade on this not too long ago, and I love it. And by using trade alerts, and as you can see, I have a host of them listed here. I use a rules-based approach. If, like with this chart, we retest support, then I'll look to get long. If it does not fire off that alert, I'm not interested. And it keeps me from making impulse trades. So leverage TrendSpider. Use the link below, get 35% off. Discount code CON35. Let's go to Alibaba. All right, so monthly chart. We are retesting support at 250.74. It's holding. We bounced off the lows of the week. I will say this. Let's see if we got more than 6 years worth of data. We don't. 6 years worth of data. So this is thin data in terms of seasonality. December is not a wonderful month, and it doesn't get a tremendous amount better. It's 50-50 for the month of January. But again, this is 6 years worth of data, so very thin. Now, looking at the analyst rating, and I really don't care about who's got buys on it and the whys behind it, because I wouldn't give you 2 cents for their opinions. What I worry about are the number of buys versus holds, which is akin to being a sell rating. Now, you have a tremendous number of buys here versus one hold. So that is a ratio that is pretty scary. So what I use this for is to determine what type of headline risk am I looking at here? Meaning, do I have a high number of analysts that are willing to issue holds or sells on the stock, changing from buys? We do. We have a lot of buys on this, so that provides us with headline risk. You know, sure, they could reiterate their buy rating, but that doesn't mean all that much unless they raise the price target. So I don't like the analysts, the ratio of analysts from buy to hold. We're holding support. Let's do a deeper dive. Weekly chart. It looks as though we may pop here. Perhaps have a W formation setting up. If you wanted to buy the shares, nibble, use a stop loss right below last week's lows. Test the market. I would not get aggressively long right here, right now. I would be looking at, you could do 2 ways. One, you could take off the automated trend lines, wait for a breakout above 260 to go adding, or to be a little bit more conservative, wait for a close above 277.75, and that would be really good price action. Then add more above the pivot point at, let's call it 282, which we saw the week of November the 23rd. That was the high of the week. Daily chart. I don't like the price action here. Daily time frame, we were rejected on Friday at a big volume shelf, right where our volume-weighted moving averages in yellow. Given the price performance of the market today, we'll probably get selling. So I don't see any compelling reason to go getting long right here, right now. Let's see how we close out the day. Do we get a bullish key reversal? If we do, well, good stuff. If we sell off hard, close down below support, you'll be patting yourself on the back that you showed discipline and didn't go buying early in the day. Because I have a meme. I love this meme. This is in the members area. Right here. I bet he's thinking of other women. I got to stop buying at the open. So true. So true. So I look at this probably twice a week just to keep refreshing why I do not go buying the open. All right, folks. Everybody have I went over the Dixie earlier, Tommy, so if you want to scroll back, I think that this is a bear market rally. I think it's going to fade. So when you have $120 billion a month of debt that the Federal Reserve is accumulating, I mean, we're sowing the seeds of our own demise. They want a weaker U.S. dollar to inflate away the debt. The problem is that when you have panic in the streets because an egg is now costing $2, then they're going to have to deal with the populace. So it's a double-edged sword. I think that they're going to rue the day that they demanded inflation because they want an average of 2%. Good luck with managing that with the amount of debt that they are printing. So longer term, weaker U.S. dollar. Everybody have a really great and profitable trading day. And if you're checking out, everybody have a happy Hanukkah, Merry Christmas, and be well.